Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the Fed decides. We'll have full coverage on the Fed's all-important rate decision this week. And we'll dig into the trades to watch ahead of that decision as gold sees its best run since 1979. Plus, Nvidia probed in China amid accusations of violating anti-monopoly laws. How will that play into trade talks? We'll discuss that and more on Market Catalysts. First up, though, let's get a check of the markets, and we continue the record run that we have seen for the major averages, or at least for the S&P and the NASDAQ. We've got the Dow gaining about 77 points today, just shy of 0.2%. We see the other majors gaining more. The S&P up about 0.5%, reaching an intraday record, as is the NASDAQ Composite up about 0.6%, and at that a record level as well. Digging beneath the surface here, one of the notable movers that we've got today is Alphabet. Now, not necessarily any headline specific to this stock, but it is rising today to a new record as well, up 3.6% here as we see it on the day. If you look at the year-to-date action, we've now got a gain of 32%. And it's interesting because it's come back and then some from those March lows. Something else to keep in mind when it comes to Alphabet here today is it's above $3 trillion in terms of market cap. You see it has reached that level, joining Apple, Microsoft, Nvidia that are all above that market cap level. And then when you look at the sectors within the S&P 500 as well, going back to the percentage change on the gain on the day, percentage changes on the day, you've got the XLY, which is consumer discretionary and communication services, which includes some of these individual big tech names. Those are both trading at records as well today. So interesting that even as we have a backdrop of the Fed presumably preparing to cut rates, some concerns about the job market, that you've got consumer discretionary as something that's outperforming and something that is as a record again today. And then also just want to get a quick check of the bond market as we head towards that Fed meeting this week. Of course, we're going to be watching rates very closely. If you look at the 10-year yield today, we're at 4.04%. And that yield has really been coming down. Let's look at a 3-month chart here. You see the big slump that we've had in yields ahead of going into what is anticipated to be not just one cut, but perhaps cuts in the coming months as well. And let's dig into the Fed now, because all eyes will be on the Federal Reserve this week, the FOMC policy meeting getting underway, plus Fed independence in focus as Governor Lisa Cook's lawsuit against the Trump administration continues to develop. Here with what to watch, Yahoo Finance's Fed correspondent Jennifer Schonberger, setting up for this busy week, Jen.
Good morning, Julie. The Fed widely expected to cut interest rates by 25 basis points on Wednesday. But the bigger question is, how many more rate cuts do Fed officials see for the remainder of this year? Will it be one more rate cut, as we saw penciled in back in June for a total of 2 rate cuts this year? Or will we see 2 more for a total of 3 rate cuts? And that will hinge on how worried Fed officials are about the state of the labor market now, juxtaposed with inflation. Inflation still running a full percentage point above the Fed's 2% target. And Fed Chair Jay Powell has said that he expects any increase in tariffs will result in a one-time increase in prices on inflation, but it is the Fed's job to make sure that it doesn't turn into persistent inflation. At the same time, we have seen a slowdown in job growth over the past 3 months during this summer, with job growth actually turning negative in the month of June. And so the Fed has to balance both sides of its dual mandate. The fact that inflation is still well above their 2% target is probably going to keep the Fed from cutting as much as they would have, given what is going on the job side of their dual mandate. Now, at the same time, the president is trying to pack the Federal Reserve with more members who are in favor of lower rates. Stephen Miron, the president's nominee to replace Fed Governor Adriana Kugler, is expected to be confirmed by the full Senate this evening to be put on the Federal Reserve Board just in time for the policy meeting, which kicks off Tuesday morning. At the same time, the president fired Fed Governor Lisa Cook on allegations she claimed that 2 properties she purchased as primary residencies to try to get more favorable loan terms. But new findings over the weekend reveal that a condo that Cook purchased in June of 2021 was put down as a vacation home, a characterization that could undermine the president's allegations that she committed mortgage fraud. Also over the weekend, we learned that Cook's lawyers put in place a new filing asking a U.S. district court to reject Trump's emergency request to remove her from the Fed. U.S. District Judge Gia Cobb ruled last week that she could remain on the Fed board while disputing the president's firing, saying that the Trump administration hadn't shown valid cause for removing her or giving her rights to her due process. So as of right now, she will attend the Fed meeting. Now, of course, the Trump administration has asked an appeals court to reverse that decision. And lawyers for Cook argue that Trump has not shown sufficient cause to fire her and that removing her would threaten central bank independence. Cook's lawyer, Abby Lowell, wrote in one of the briefs over the weekend that was filed, quote, "A stay by this court would therefore be the first signal from the courts that our system of government is no longer able to guarantee the independence of the Federal Reserve. Nothing would then stop the president from firing other members of the board on similarly flimsy pretexts. The era of Fed independence would be over." Lowell noted that the risks to the nation's economy could be, quote, dire, and that, quote, even the perception of political influence could destroy investor confidence, hurting economic growth and stability. Julie?
Jen, thanks very much. Looking forward to your continuing coverage leading up to the Fed. And let's talk more about what investors and economists are looking for. Investors expecting the Fed to kick off a cutting cycle this week. They'll be listening closely to Chair Jay Powell's commentary for signs of how many cuts could be ahead. For more on the future of the Fed, I want to bring in John Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor, and Paul Grunwald, S&P Global Ratings Global Chief Economist. Guys, thanks so much for being here. John, you do a really interesting survey of former Fed officials. You ask them all kinds of things, but obviously you ask them about policy. And I thought it was interesting in your latest, there's a pretty even split between the former Fed officials on where they think policy is going to go after this week's meeting, in terms of how many think it should stay, how many think there should be more cuts, fewer cuts. And I guess that's sort of reflective of the challenge that's in front of the Fed right now.
Right. So this is a survey I do in cooperation with Duke University ahead of the Fed's own forecast updates. And what it shows is that most former Fed officials, these are former governors, former regional bank presidents, former staff members who participated in the forecasting process, think the Fed is going to pencil in 2 rate cuts for the remainder of the year. One this week, and then the other one would presumably be in December. And this is at odds with what the market expectations is. The market puts an 80% probability of another Fed rate cut in October and then one more in December. So, this is the way I describe it. The Fed is in a position where it's more dovish now than it was back in June. So back in June, the job market didn't look as weak as it does today. We've gotten a lot of downward revisions to payroll numbers. The overall growth rate of payrolls has slowed. So the Fed is certainly more dovish. It's just not as dovish as the market thinks it's going to be. And Powell is going to have to thread that needle in his press conference tomorrow. He'll open the door to 3 rate cuts this year, but he's not going to open it so wide that people see it as a guarantee. I think he would like to have like 50-50 odds in the markets of another move in October, not 80% odds.
Paul, what are you thinking here in terms of, because as we've been discussing, there's not a heck of a lot of suspense over whether there's going to be a rate cut this week. The market thinks it's a certainty. What then do you think is likely to happen?
Well, I think the 25 basis point cut for this week is pretty much baked in. But, I agree with John. There's a lot of mixed signals right now. So we've seen the weakness in the labor market. We've been writing that the kind of foundation of the labor market strength has been narrowing, right? It's basically all healthcare right now. And, we've got mixed signals on confidence in the economy. The GDP is actually tracking 3% in this quarter. And as you reported earlier, bond yields are down. We see spreads down. We see that in our business with issuance, and equity prices are up. So financial conditions are already pretty loose. So I think, there's definitely a case to cut rates this week. And we have one more penciled in for the rest of 2025.
Well, and Paul, as we know, interest rate policy is kind of a blunt instrument, right? It's not a precision tool here. And so how much upside is there, given, as you say, financial conditions are already pretty loose? How much is a cut going to help the labor market? And how much is it potentially going to exacerbate the inflation issue?
Right. Well, inflation is going to be tricky, right? Because all the inflation measures have picked up, whether you look at PPI or CPI, and we know that the tariffs are going to feed through. Chairman Powell thinks that's a level effect, and we agree with that. The optics aren't particularly good right now, but it's really back to financial conditions. That's what maps into GDP growth and ultimately labor demand. So the Fed rate cut, which is baked in already, is going to help, but it's really the financial conditions, equity prices, bond yields, and spreads that are going to be mapping into the macro outcomes.
And John, we have talked also a lot about the changing face of the Fed in terms of the players there. As Jen was just talking about, even at this meeting, is Stephen Myron going to be in there? We don't know. I guess there's still a chance Lisa Cook, depending on the outcome of this back and forth in the courts, might not be in the room, but it seems like she probably will be. And I was struck by, again, going back to your Fed survey, that Christopher Waller was overwhelmingly the choice of the folks you surveyed. Is that just sort of institutional bias, perhaps?
No, well, no, I think what they see, well, maybe there's some institutional bias because Chris Waller is a Fed governor. Not only is a governor now, he used to be the research director at the St. Louis Fed. So what I do is I'm surveying these former officials. I got 25 responses. 21 of them said that Chris Waller was the best choice among the 4 people who are most commonly cited as on the short list for to get the job after Powell's term ends. And what everybody said is that they thought that Waller was the most likely to be an independent decision maker, which is another way of saying least likely to be overly influenced by the White House about what the interest rate should be. And now, so here's the twist. Because he's seen as someone who's independent minded, a lot of the people who said he's the best candidate don't think he's going to get the job. Among the other candidates that we put out there, Kevin Hassett, who's seen as a front runner, the National Economic Council chair to the president, he got 0 votes. Not a single former Fed official said they thought Kevin Hassett would be a good choice.
Paul, what are you thinking here about, who's going to be the next chair of the Fed?
Yeah, well, we're not going to jump in on the horse race, but I think I want to underscore the importance of Fed independence. I mean, the market puts a huge weight on that. That's a huge institutional advantage of the U.S. So I think any choice that preserves that independence and all the benefits that come with that is a good one.
Paul,
hey, Julie, can I throw in one other
Sure.
point here? In this survey, we also found overwhelmingly former officials thought that there was a serious risk that the Fed was going to make a policy error over the next few years because of a loss of independence, because the board might be stacked by loyalists to a president who wants much lower interest rates. So the reason they're so overwhelmingly coming out for Waller is because they think he'll uphold some independence. And here's the important point is, I think this probably reflects the market's preferences too. I think Waller would be seen as someone in the marketplace who would make sound judgments. And if the White House comes to a view that it's got to reassure the markets, we might see Waller sneak up in this race and land a job that a lot of people think he's still kind of in the back of the pack on.
Paul, how concerned are you about the policy mistake potential?
Well, the thing to watch if that's going to happen is medium-term inflation expectations, right? Expectations of inflation in the U.S. are pretty well anchored around 2%, and that has lots of benefits. For example, right now, Powell and the Fed are looking through the tariffs as a one-time increase with no second-round effects. If we start to see a perception of inflation bias in the Fed, let's maybe that's a loss of independence, that's going to make their job in getting the 2% inflation target much more difficult in the future. They're going to have higher rates, tighter financial conditions, and probably slower growth.
Yeah. John, good to see you as always. Paul's going to stick around because coming up, we'll discuss the importance of a U.S.-China trade deal. Negotiations are underway, and Paul is just back from Asia. We'll be right back. Treasury Secretary Scott Bessent meeting with the Chinese vice premier in Madrid for negotiations as the U.S. and China attempt to firm up a trade deal. Areas of focus include the steep tariffs imposed by the U.S., currently paused, and the deadline for a TikTok ban in the U.S., with Bessent saying the nations are very close to a deal on that item. Still with me, Paul Grunwald, S&P Global Ratings Global Chief Economist. Now, you were just in Asia for S&P's Asia Pacific Petroleum Conference. Yes. I want to talk about petroleum in a minute, but first I do want to talk about these trade negotiations because they've been sort of ongoing. And at first, it felt like the market and economists such as yourself were ascribing a lot of importance to these talks and to this agreement getting done.
Right.
And it's sort of fallen to the back burner a little bit here. So how important is this U.S.-China trade deal?
Well, we've seen the rest of the tariffs, which have kind of settled down. My team's always said it's not the tariffs per se, it's the uncertainty around the tariffs that's really pushing down the macro view. So depending on where we land with the China negotiations, that may or may not move the needle. But I think the ask here or the wish is to get some sort of certainty around where we're going to land, because this is the big one that hasn't been nailed down yet. You know, we could maybe argue India, et cetera, maybe Brazil. But this is the one that if we can get some clarity and it's going to be something that we can, you know, bank on for a couple of years, I think that's going to be good, because that's the getting rid of the overhang, which is what we want.
What was the chatter there at the conference around tariffs in particular?
Being an energy conference, it was actually surprisingly low. A lot of stuff around oil prices. I mean, U.S.-China was everywhere. The geopolitical rivalry was everywhere. But to your point, there was surprisingly little chatter about tariffs at a global energy conference. You would have expected more.
Yeah. Why do you think that is?
Because of what we just discussed, there's kind of clarity around everything else.
It.
But the big elephant in the room, which is U.S.-China bilateral tariffs, hasn't been resolved yet. So hopefully we get some clarity on that one.
So let's talk a little bit about U.S.-China competition within the energy landscape, because what did you learn about sort of where we are in the energy transition on a global basis?
Yeah.
Are we seeing sort of, obviously here in the U.S. we've pulled back from the energy transition.
Right.
Is Asia just sort of full steam ahead, and is that leaving us in the dust?
Point one is the energy transition's not dead, even in the U.S. You know, the U.S. has probably slowed its transition, but the rest of the world's kind of full steam, and we know about the clean tech in China and moving to electrify, right? Wind and solar. But China's always also stocking up on their oil. So one of the things that's been keeping oil prices a little bit higher than they would normally be given the oversupply is that China's been restocking. But the bottom line on the energy transition was kind of all of the above. It's not going to be fossil fuels or renewables. We need a lot more energy. Data centers are going to suck up a lot more energy. The global south still needs to grow. So, there'll be a kind of reduction in fossil fuel usage over time, but it's not going to be a cliff with all these stranded assets.
Right.
But, it's going to be both. All the above is what we need.
Which is funny because that's also what U.S. Big oil company CEOs have been saying for a little while now also, is that it needs to be everything.
Yeah, this came out very clearly at our recent CERAWeek in March. I think I saw you there, and that's been the view for some time. The big oil companies have both a sort of a fossil fuels wing and a renewables wing, but we need everything right now, so that's it.
So, that said, that even if the energy transition is not dead here in the U.S., when you look at the U.S. versus China, where they are more explicitly fostering the growth of that industry, is there a risk that we leave some economic growth on the table if we are retrenching from some of those priorities?
If our comparative advantage is in fossil, not necessarily. The other angle to that is maybe kind of influence with the global south, because China's producing electric vehicles and battery and solar and wind, and they still have their structural oversupply model, so they've got to export that somewhere if they can't consume it domestically. Big push into a global south, which may not be bad for the energy transition, right? The countries in the global south get electric vehicles and good batteries and solar faster. But there's that other kind of dimension there that's very interesting to follow.
Just curious, what surprised you the most in what you heard at the conference?
Well, the lack of talk about tariffs was one of them. I think this kind of new consensus, not a surprise, but this new consensus around energy, they call it energy pragmatism. I think everyone's kind of landed on that. So even, if we can use this term, kind of the hardcore climate folks have kind of come on board that we need fossil fuel in the interim. So I think there's some convergence around that, and that's good to see, and that's going to be helpful.
Paul, good to see you. Thanks
Likewise.
for coming in. Appreciate it. Coming up, we got today's top calls on Wall Street. More details ahead.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Kicking things off with Micron. Deutsche Bank just raised its price target on shares to 175 from the prior 155, saying demand for high bandwidth memory, those are the chips that power AI data centers, that remains red hot, and it's keeping supply tight and prices strong, with margins expected to push above 50%. Other analysts like UBS and Stifel are bullish too, although Goldman is a bit more cautious with a price target of around 130. Shares are currently trading at just under 160. Next up, the real. B. Riley Securities is raising its price target on the secondhand luxury retailer to $12 from the prior $9, citing, quote, a significant margin runway and undervalued stock. The call comes after management meetings offered more confidence in the company's long-term growth and margin expansion, especially as it leans into AI-driven inventory processing. The stock is already up nearly 80% since July, far outpacing the S&P 500. Supply does remain a constraint, but accelerating consigners is one bullish sign. Finally, Beyond Meat. Argus Research cutting the stock to sell from hold and pointing to slowing sales and a weak balance sheet. The company's second quarter revenue falling 20% year over year, and its guidance calls for another drop in Q3. Shares are off just over 1% today and are down nearly 30% since the start of the year. Wall Street is largely cautious here. The stock has 0 buy ratings, 5 holds, and 6 sells, according to Bloomberg. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching CoreWeave, Oracle, and Corteva. First up is CoreWeave. The company says its cloud contract with NVIDIA is valued at $6.3 billion. That deal, which was first announced in 2023 and runs through 2032, requires NVIDIA to buy any excess capacity not used by its customers. CoreWeave has secured billions in deals to provide capacity to companies training AI models, including OpenAI and Microsoft. Amid news of this deal, there are some investors who are skeptical of CoreWeave. Kerrisdale Capital says it is short the stock. Bloomberg News reached out to CoreWeave but has yet to receive a comment back from that company. Next up, Oracle getting a boost amid updates from the U.S. on reaching a framework for a TikTok deal. Treasury Secretary Scott Bessent told reporters in Madrid that they have reached an agreement with China regarding TikTok. Oracle has been TikTok's secure cloud technology provider since 2020. It also manages its U.S. user data, ensuring compliance with U.S. regulations. Oracle's cloud services handle all of its data storage with the aim of keeping U.S. data on American servers. And finally, Corteva, the Wall Street Journal reporting the $50 billion seed and pesticide maker is exploring a breakup. The company, which was once part of Dow DuPont, could finalize a plan soon. Since its spin-off in 2019, the share price has climbed nearly 150%, including more than 25% so far this year. The company supplies farmers with weed and pest-killing chemicals and the biotech seeds designed to withstand them. Corteva is seen by investors as one of the best-performing companies in U.S. agriculture, partly because of the success of its Enlist-branded soybeans that make up most of the market. Interestingly, usually you get a headline like this and the stock goes up. It was up in pre-market trading, but right now it's down nearly 4%. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we'll take a look at the recent run-up in gold. But first, Opendoor investor Eric Jackson shares his thoughts on the company's new CEO. That's on the other side of the break.
Opendoor has become one of Wall Street's most talked about stocks. Shares soaring nearly 80% in a single day after naming a former Shopify executive as CEO. Stock is now up more than 400% this year, and our next guest has confidence that this isn't just another meme stock, it's a real turnaround story. Joining me now, I've got Eric Jackson, founder and president of EMJ Capital. Eric, it is great to see you on set. So let's talk all things Opendoor, Eric. You had a new CEO. Co-founders coming back to the board, some big names there. Walk me through what this means. And I'm curious, Eric, just how you think about what the business strategy is going to be here and how Opendoor, in your opinion, succeeds with just the brand, the tech, the platform they have now.
Well, Keith Rabois has been the most outspoken guy on Twitter, like up to this point, out of any of them, in terms of sharing his thoughts. He never holds back. Like he has no filter. Just like what he thinks he says. He's very was very critical of Carrie, the former CEO. Said she was like a Scully, and needed to be gone as ASAP. He was right, by the way. And so I tend to think my personal belief is like he's the smartest guy in tech, in bar none. Okay, I agree with Keith. He's not always 100% right. None of us is, but he tends to be very, very right and very on the money and knows how to create value. So he's already hinted like there needs to be major job cuts here. There needs to be like a focus on AI. There needs to be an explosion of the number of sellers and buyers like on Opendoor transacting. And this can be the Amazon of housing if they get this right. Now it's been kind of validated, that view, because obviously he's back on the board now. He had a major hand in hiring Kaz, the new CEO. Keith thinks that Kaz is going to be like the Travis Kalanick in terms of how he goes about this. There's apparently been a big like work from home ethos at Opendoor. That's gone. Everybody's going to be in the office now. Keith said this company could survive with like 10% of the current workforce, and the rest done through AI.
How big is that workforce right now?
1,407 people currently, according to Bloomberg. So he's talking about going down to like 100-person, 150-person workforce. Probably, so it would be a major difference. So the bearish case against Opendoor before Keith announced the 80% update yesterday, and Keith and Kaz coming back was like, iBuying's never worked, therefore it will never work. And this company has failed before. It's a little dinky company, $3 billion market cap or whatever. Like why, it won't be successful. So mind you, like that argument would have said that when Steve Jobs came back to Apple, just shut it down then. There's no point in continuing because it hasn't been successful to this point.
Which some did say, by the way.
Michael Dell did say that.
Yep.
So anyway, but then you say why would the number 2 guy at Shopify, who probably if he played his cards right would be the CEO relatively soon, widely respected in the world of tech, everyone loves him. Why do we leave Shopify and take the job as CEO of a I don't know, before the 80% update was probably a $2 billion, market cap company. Obviously, he sees the same vision that Keith does, and he thinks that this can be the Amazon of housing. First in the U.S., but then the Uber playbook is you blow that out worldwide, international. So, obviously he sees this as a big opportunity, and I agree with him. And so, the bears really don't have a leg to stand on now.
Let me ask you this. I was talking to an analyst who covers the name this morning. He brought just a question up, which I want to ping off you. He said, how, in his opinion, the model sort of changed in Opendoor, meaning they began to really kind of meaningfully integrate real estate agents. Whereas the original mission, his point was, hey, much more just direct buying and selling with the consumer, leave the agent out. And I'm just curious, how does that sort of change the value proposition? And is it still so different, Eric, from a traditional brokerage if you're doing that?
I think if Keith was here, he'd say, no, it's not different, Josh, and that's why we got to get rid of it, the agent relationship. So he's very kind of Keith is very much we got to blow it up, and we got to do, a lot of people just don't want to pay 6% commission rates to agents. And so we should be building a platform that deals directly. So again, the truth is iBuying is a low gross margin business. That's true, yes. But in Carvana's world, buying and selling used cars, they make almost no profit from buying and selling of the cars. They make something like 80+% of their profit from finance and interest. And I think the view of Keith and the kind of the new regime will be hey, we can make some money here, not just iBuying on its own, but iBuying with mortgage and title, and with AI and dramatically reducing the workforce here. We can make some money here, and we can have a disruptive model that doesn't need to use the agents. I don't think they'll do that right away, though. If there's a way of playing nice with the agents, maybe in the next few years as they transition, they'll probably take that money and take that opportunity. But I have no doubt that they have this longer term view of we got to blow this up, just like Uber blew up taxis.
One question I got from an analyst was, he says he's hearing from his clients. You mentioned Keith. One question they get is, how do they actually get Keith to come back? And just so viewers understand, Keith Rabois, big name. I mean, that is a very well-known, well-respected, wildly successful venture investor. What were those conversations like to get him back?
Like between me and Keith?
Yeah.
Well, I mean, I had this meeting yesterday with a guy who's like a CEO of a private company that Keith's backed. And he was like, man, great job on Opendoor. And I was like, thanks a lot. And he said, like the funny thing is I had a coffee with Keith in June. And I was like, wait, what's going on with Opendoor? And Keith was like, I don't know, man. Like those guys, like they're hopeless. This is things like circling the drain. And that's like less than 3 months ago. And like, so we went from like, him believing like this thing, and it was circling the drain. I mean, this was 51 cent a share stock price on June 25th. And so I, along with the Open Army, we sort of like said like, hey, there's more value here. We breathed life into it. I think it got Keith energized. I started communicating him after like he was seeing like, hey, something's going on here. And we would have these like very cryptic like exchanges on DM or email. I didn't actually meet him until a week ago here in Soho. And he is just as brilliant as I thought. I was like way more excited after hearing like his vision and some of his ideas, which are now going to be put into place. And so I just think he got energized. And that's what this guy, the CEO, told me is like, man, he's all in now, and now he's tweeting out stock price charts and stuff, and I've never seen Keith do that before. And so he was on CNBC earlier today, I believe. I haven't had a chance to see it yet, but he's a brilliant guy, and like the company and shareholders are so lucky to have him and his full force and intellect and energy behind this.
Big name to get back in. Eric, thanks so much. Appreciate it.
Gold has had a massive run up this year, outpacing even big tech as it has notched over 30 record highs. It's the best performance for the precious metal since 1979. Joining me now, Bob Iaccino, Chief Market Strategist at Path Trading Partners and a longtime commodity watcher. So, Bob, when we look at this incredible performance that we've seen for gold, I guess, first of all, just to set the table, let's talk about what has driven it to such an extent, right? What do you think are some of the primary factors here?
Well, I think the key factor is, Julie, that people talk about gold being an inflation hedge. And it's an inflation hedge when the Fed is not fighting inflation. When we saw that little bit of a pullback, let's call it August or so of last year, April or so of last year, in that range, the Fed had been kind of on the fence about rate hikes, going to neutral, rate cuts. Now that the Fed is fully back, at least in the market's view, into the rate cut realm, and you still have inflation annualized at about 2.9% according to CPI, if you take the uptick that we got in the last batch of data, it's actually much worse than that. The headlines annualized at about 4.6%, and the cores annualized at about 4.2%. I think last month data might have been a blip based on the increase we saw in shelter. You're looking at a Fed that is not prepping to fight inflation, and inflation is still uncomfortably high, at least versus their 2% target. And when that happens, you get gold strength. The second point of that is central bank buying. That has not slowed. China just reported last month that they bought for their 10th month in a row. And if you look at central bank holdings, China's playing catch up. They're in 6th place. And that's not counting the IMF. If you put the IMF in there, China's in 7th place in terms of total, let's call it global institutional holdings of gold. So gold has been very popular in terms of the buying from institutions, the major global institutions like the central banks, like the IMF. And then you put this inflation story in there as well, and gold has a really strong tailwind behind it. We're working today on potentially another all-time record high close in the futures.
And what's also one of the other fun stats that I've been seeing about gold is on an inflation-adjusted basis, that it is now surpassed its previous record in 1980. There's the inflation-adjusted gold chart. So January 1980 was the prior peak for that. So even adjusted for inflation, it surpassed these levels. So the question now becomes, Bob, those various elements that you talked about, they don't really seem to be changing. But does that mean that gold still has a lot of upside from here, or is it just going to sort of stay around these levels?
Well, so there's something interesting going on right now. Looking back to, let's call it May of this year, we've seen gold in what I would call a sideways correction until the recent breakout. Now, the recent breakout level to me is about 35, give or take. I mean, when you've got this many attempts at a breakout, you can't pick the exact level. You're looking more at a level area. So I could see a pullback to that area. And the reason I say that is because we're in the seasonally weakest period for gold right now. September is the worst month for gold. It's tied with a couple of other months, but when you look at it historically, it's not a very strong month. You look at what we're going into, October and December, very strong months for gold. I suspect the October strength comes from the stock weakness, right? And you get that flight to safety. But gold has been performing through its worst seasonal month. Now, some people might say that means we're going to look at a catch up to the downside. Other people might say, well, that proves that it's going to be strong into the end of the year. I don't look at seasonality as a trading strategy, especially for commodities. But when you're looking at what gold has done, I could easily see a pullback as money comes out of gold and goes into stocks. But the broader picture is that the dollar is likely to continue to stay weak. We have 5 rate cuts priced in through 2026, according to the CME Fed Watch tool. That includes this Wednesday's meeting, the 17th. So if you get a cut there and you get a dovish Fed, and I mean more than the market is expecting, the market is expecting dovishness, then you get a continued strong rally. Otherwise, you're likely to see profit taking in that typical buy the rumor, sell the fact situation. So I think we could see a pullback, but that is not going to turn into a bear market, in my view, anytime soon, unless we get an absolute collapse of inflation and a Fed that has decided that the labor market is strong, there's no inflation they have to fight, but the economy is strengthening so they can stop the rate cut cycle. That's likely when you're going to see the turnaround in gold.
And that doesn't seem like it's a short
It
or
doesn't.
intermediate
It's the least
term
likely scenario,
thing
in
that's
my
going to
view.
happen, right? Bob, is everything that is true for gold true for silver? Because silver, by some proxies, has outpaced even gold this year in terms of its percentage gains. So are we going to see it pretty much behave in a similar way?
Silver's got enough of an industrial mix, Julie, that it actually is going to suffer a little bit more if we get a larger slowdown where gold won't. Right now, silver's playing catch up. It is not the poor man's gold, in my opinion. Every time I've tried to buy silver because I thought gold was too expensive, I lost money, literally every time. So you have to look at silver as more of a mix. And this might actually be a good situation for silver, this particular mix, because we have an economy that's weakening but not going into recession, in my view. And we have a situation where the dollar's getting cheaper. That's good for silver. The industrial uses of silver is probably still strong enough, and it does need to play catch up. That gold-silver ratio is likely reset at a much higher level. We're not going back to the historical norms of 40 or 50 where it was over, say, let's call it the last 80 years. That's not likely to happen. So we're ratcheting back up to a higher gold-silver ratio, but silver's still going to catch up and set it at that mean of about 80.
Bob, always great to get your perspective on this stuff. Thank you.
Good to see you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. We'll be digging into the latest Chinese economic data next. Coming up this hour on Market Catalyst, first up, we'll discuss the latest on trade and tariffs as the U.S. and China meet in Spain. Plus, Alphabet reaches a $3 trillion valuation. We'll break down what Wall Street has to say. And how should you invest in the utility sector? We'll have more in today's Investor Playbook. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. If we look at the major averages, we see a rally that is pushing once again to records, at least for the S&P and the NASDAQ. The NASDAQ leading the majors today. It's up 0.75%. As we mentioned, Alphabet, a part of that, it's hitting a new record today at that $3 trillion valuation. We'll dig into that in a bit. But first, let's talk about China. The economy there slowing in August. That's according to a release from the National Bureau of Statistics. Retail sales, industrial output, and fixed asset investment among the measures expanding less than expected. My next guest says there are still opportunities for investors to buy into Chinese companies. Let's bring in Andrew Mattock. He's Matthew's Asia Portfolio Manager. Andrew, thanks for being here.
Yeah, no problem.
So you had this economic data on the one hand. On the other hand, you have headlines coming out of Madrid where Treasury Secretary Scott Bessent is meeting with the Chinese vice premier, trying to get these negotiations on trade further along. The initial headlines have said they are making some progress, President Trump scheduled to speak with President Xi on Friday. So does that outweigh some of the economic data, or how do you think about those factors?
Yeah, I mean, two things going on at the same time. You know, like you mentioned, the domestic side in China has been soft, really. The property market has been soggy for 4.5 years. So the data there hasn't been great, but at the same time, they are going through this transition on property. And you know, the old story was in China, when property goes down, China goes down. Well, that hasn't happened. But markets in China were priced, you know, very cheaply. So we have seen a rally that's been very aggressive in the last year. If you look at the Matthews China Fund, it's up sort of 65, 70%. And so we're coming off of, you know, very depressed valuation level. And then the second thing you mentioned was Trump and trade. And Trump and trade, all the rhetoric coming out of Madrid, potential TikTok deal, you know, things are moving in the right direction. So that's just sort of where we're at the moment.
And ever since this whole trade kerfuffle began, we've sort of been having this discussion of who has more to lose, who has more to gain. How do you think about that through the lens of China?
Yeah, I think you're right. I think, you know, both sides are walking into this, you know, as equal parties. I think if one side could have steamrolled the other, then, you know, we probably wouldn't be sitting here still talking about it. So it's been going on a long time. I think both parties, it's in their own self-interest, if you want to put it like that, to work something out. And that certainly seems like the direction that we're headed. So, you know, both big economies, you know, number 1 and 2 in the world, it's important. I think it's important not just for the countries, but for companies as well, to be able to plan for the future when it comes to where do I put my manufacturing, the level of outsourcing required, national security. I think all these things are important, they're being discussed, but like I mentioned, we're moving in the right direction.
Well, and as you also mentioned, I mean, Chinese stocks have been up immensely over the past year. So what now? I mean, how much further upside is there, and what are going to be the catalysts for that upside? Is it going to be a trade agreement, for example?
Yeah, I mean, there was just a lot of factors on the way down that was sort of, as you sort of mentioned at the start, you know, the domestic economy was weak. No one knew where that bottom was in terms of the domestic economy. We have a better feel for that now. And then the trade negotiations were sort of up in the air as well. And that led to Chinese markets. I remember at the peak, people were saying they're uninvestable. And we'd sort of got to levels where, you know, in terms of price levels, you were trading back to where you were in 2007, to put it into perspective. So that's sort of how cheap we got. So you don't need much good news to rally from there. Now what we need, you know, what we really need to come along is that the property market needs to finally turn after 4.5 years. That feed into consumer sentiment, and we go into a new earnings cycle, and valuations are still there. So that's sort of yet to come.
So I guess I would then turn the question I just asked on its head a little bit. Instead of what's going to keep it going, what are the biggest risks to the rally continuing? Would it be, you know, if the property market doesn't turn, for example, and what's the timeline on that? I mean, if you've been waiting this long and it hasn't happened yet, and stocks have rallied anyway, does it, you know, how much does it matter?
I mean, I think it matters a lot. The property market is very important. At the same time, we are seeing clearance. So there is results. It's just that the Chinese government is letting the market clear. They're doing a little bit of stimulus, but not a whole lot. They're letting it clear, but that takes time. So the risk is that the Chinese market, or the Chinese property market, never recovers. But what we're seeing is that we are seeing a recovery in terms of inventory levels, in terms of unsold property go down. So we're moving in the right direction. Exact timing, unsure. But I think things are getting cleared. The Chinese economy is also going through a transition that they've highlighted in terms of they want to develop the consumption service side of their economy more aggressively, away from fixed asset investment. But you know, it does take time. And I think time's the biggest drag rather than is it going to happen.
Gotcha.
Yeah.
When I look at the biggest weightings in that Matthews China Fund, you've got the companies that we know about here in the U.S., at Tencent, Alibaba. Those are your two biggest holdings. You also have some financials in there.
Yeah, right.
You know, and again, all of this has worked for you. How do you think about that mix and what people should be overweight when they're looking at China?
Yeah, I think as a result of the property market obviously being the biggest asset, for a citizen in China, if you like, the diversification into other types of asset classes is very similar to what the US went through many, many years ago. But into things like funds, things like ETFs, stocks themselves, financials. The biggest brokers in China also own the biggest asset management companies. So, they do the investment banking, they do the broking, they have also big asset management arms as well. So that has worked. In addition to that, something like, life insurance, where people are looking at life insurance as real life insurance rather than an investment-related product. So they're starting to view capital markets, they're starting to view these types of, if you like, financial companies, and their products a little bit differently now as well.
Thanks so much for coming in. Really
No
interesting
problem.
stuff and an interesting moment, as it turns out,
Yes,
in the
absolutely.
trade talks as well. Appreciate it, Andrew. Thank you. Coming up, we'll deep dive into the crypto market and how new crypto-related companies are disrupting the payment space as well. We'll be right back. Well, crypto companies have a major presence in the IPO market so far this year, with big debuts from the likes of Gemini, Figure, Bullish, and Circle, all crypto-focused companies ranging from stablecoins to lending and, of course, trading exchanges. Non-crypto-related companies that are also betting big on the space, stockpiling coins in treasuries. Of course, Strategy, formerly known as MicroStrategy, was the first business to really adopt and make a name for itself with that practice. And now GameStop, Trump Media and Technology, biotech company Cosmos Health, and others are joining in. Joining me now is Andy Baer, Managing Director at CoinDesk Indices. We should mention Bullish is the parent company of CoinDesk. Just a quick note as we talk about all of these IPOs. Andy, it's good to see you. Thanks.
It's good to see you too. Yeah, there's nothing like New York Stock Exchange bell ringing. So when Bullish went public on August 13th, it was really exciting, and the company's really excited to proceed. So even though that bell ringing in the IPO process feels very, very traditional in the equity markets, it's still kind of
there's still a thrill for me. I've done it as well, and it's definitely a fun thing to do. And again, sort of like captures the enthusiasm that we have seen this year. You and I were just talking in the break, and I am struck by looking a year ago, 12 months ago, even 9 months ago versus now, how many more ways there are to invest in the cryptoverse.
Yes.
And these IPOs being one of those ways. How do you think about that and what it says about the industry?
It's fantastic that you have operating companies that have businesses. Now, whether they keep their treasuries in Bitcoin or other cryptocurrencies or dollars, they're still invested in the future of this new financial market. You have DATs which kind of can combine their financial engineering with how they hold things and which assets they hold on to. They can add value there, whether it's financial engineering value or diversification value. That's a distinct set. And then you have ETFs for direct ownership, or you can actually go out and buy Bitcoin or Ether yourself. So it's great. The regulatory clarity, the great news and communications we've heard from the CFTC and the SEC, which have allowed people to relax and understand that they can start businesses, they can raise capital, they can operate without any untoward surprises, has let the market flourish. So you're right, there's a lot of new things happening. I think the fact that they've all come very suddenly is just that there was a lot of pent-up demand for this. And now the regulatory environment is starting to loosen up and making it more possible for these things to happen.
And I'm wondering, as things play out, what the sort of winners and losers environment will look like, right? Because before it sort of felt like Bitcoin and everything else, whether you were talking about vehicles or the cryptocurrencies themselves.
Yes.
So how is that now sort of shaking out?
Super important point. And we still feel that Bitcoin earns a special place as the oldest blockchain, but also as the one with the most simple, macro-oriented purpose, store of value. Bitcoin doesn't really do anything except move from one address to another, although some fantastic people are trying to build something on top of that network. People should and can think of that very uniquely when they think about the rate cuts that are likely to happen this week, when they think about inflation, when they think about moneyness and their views on the dollar. That's a great way to think about Bitcoin. But one of the most fantastic things about this year, both in terms of price action and narrative action, has been a shift to Ethereum and Solana, other layer one blockchains, their support of stable coins, their support of smart contracts, their support of all these things that'll change how we do things every day, these growthier assets with a very technologically futures-oriented kind of appeal to people. That's changing things. We've seen that in the breadth of the rally this year, a big rotation from Bitcoin to Ether, and in the last month, kind of a rotation from Ether into Solana. Great for people who are following the space very closely, but for investors who are really spending maybe 2 to 5% of their time on crypto, it's a better time than ever to think about, getting baskets, getting indices, rather than trying to pick individual names.
Well, and also speaking of that, I mean, all of this is not without risk, of course. And as we have seen this regulatory opening up, we have also seen, once again, the rise, as we've seen in crypto before, of opportunism. And I think it has been argued that the White House has participated in that, or the Trump family, we should say, has participated in that. So, for investors who are trying to figure out where to go, you just mentioned the basket idea, but I guess also, how do you separate the wheat from the chaff? How should investors, as somebody who's covered this for a long time, how do you figure out what's got staying power,
right,
and what's sort of trying to take advantage of the moment?
And for someone who's a natural skeptic, right, of,
Yes.
of things, of any kind of frothy markets, I agree that there's a lot coming. The floodgates have been opened. For investors who are really gazing at the horizon and seeing what will all this stuff look like 5-10 years from now, focusing on big names that have good track records and have kind of a really understandable basis to them. And a lot of the indices that we create aren't fundamental indices. They're really based on things like liquidity, market presence, exchange listings, time since their token generating event, and size. Most of those have established themselves through just being around and surviving for that period of time. So when it comes to investment and trying to see past a lot of what is noisy right now, we don't give investment advice, but if I think it's kind of prudent to think about this asset class as you would another high growth asset class. Look way ahead, try to buy the market, and assume that the market's going to be bigger than it is 10 years from now than it is now.
Andy, thanks so much. It's always good to see you. Thanks
Great
for
to
coming
see you.
over. Well, as more crypto companies launch financial services like lending, credit cards, and debit cards, more established players in the payment space are also looking to compete. PayPal, for example, announcing a new peer-to-peer payment system that it says will soon include Bitcoin, Ethereum, and its PYUSD coin. Our next guest names PayPal as a company poised to outperform as crypto floods the payment space. Joining me now, Paul Golding, Macquarie Capital Senior Equity Research Analyst. And Paul, presumably you just heard my discussion with Andy and this idea that we have seen this explosion in ways for people to invest in crypto. But of course, there are lots of existing players who are, kind of getting in on the edges of it as well. So when you look at a company like PayPal, what are the opportunities? What are the risks in its incursion into that space?
Yeah, thanks, Julie. Good to be on with you. We've cited PayPal as being a potential leader in the crypto and commerce space. If you think back to a couple of years ago, PayPal launched its own stablecoin, PYUSD, and that stablecoin has provided some underlying infrastructure for it to develop functionalities with the characteristics that make the blockchain so interesting and effective and desirable, which is instantaneous settlement, irrevocability. It's trustless in the sense that it doesn't require some sort of settlement translation between issuers necessarily, and it allows for cross-border movement very effectively from both a speed and cost perspective. And so PayPal has actually, we've seen the market cap of PayPal's PYUSD stablecoin grow meaningfully. At one point last month, it was up as much as 40% month over month. And what we've seen is, or I'm sorry, year over year, and what we've seen is that that market cap translates to use cases, individuals finding functionality with the token, and also using it for peer-to-peer purposes. And so that theme seems to be carrying across into new product categories across other tokens and other blockchains.
And what do you think is PayPal's competitive advantage? I mean, it is not, it's been in the payment space for a long time, obviously, but it is not crypto native, so to speak. Do you think that that is an advantage or disadvantage when it is competing against some of the newer players that are crypto native?
The first thing I'd say is PayPal has scale. When we think about the number of accounts, it's approaching around 440 million on a global basis, many tens of millions of which are merchants and the rest being users or consumers or customers. And that scale creates a network effect, but it also creates the ability to drive partnerships with other payment platforms, whether they are card partners or other fintechs in other markets. And that creates this ability to have endpoints for this crypto theme that we've been discussing in terms of delivering that value to wallets, whether it's in stablecoin or other crypto terms, as well as the fiat peer-to-peer functionalities.
So where do you think we sort of go from here, Paul, in terms of more entrants entering the space, in terms of the rest of your coverage universe and how they're attacking some of these challenges also?
Yeah, well, I'll borrow a phrase from another company that we cover, Block, who's obviously a competitor of PayPal's, and management there, CEO Jack Dorsey often says that the world needs an internet native form of money, and that his view is that Bitcoin is that. But that theme, whether it's for transfers cross-border or for Web3 use cases or for hedging fiat, that theme can accelerate, it can proliferate amongst consumers as well as platforms. And we're seeing that. We're also seeing the traditional players get involved to avoid disintermediation, but also to provide infrastructure and continue to drive the value of their existing network effect, given the endpoints that they're able to tap into. And so we look at Visa and MasterCard, they are participating in that infrastructure space from a crypto perspective by enabling settlement, working with fintech partners, providing sandboxes for development, and also consulting for their issuer bank partners to get a sense of where this evolution may take the traditional deposit world and the transfers ecosystem. So many incumbents are involved. We'll have to see what kind of scale and how that scale may accelerate in the near term.
And then, Paul, finally, I wanted to ask you a question, sort of a related question, but not directly related to payments, and it has to do with the miners, right? The crypto miners, which you also cover. Many of them have been migrating some of their compute to to sort of AI data centers rather than keeping it with crypto mining. What do you make of that change, and how is it reflective of where we are in the crypto cycle?
It's a great question, Julie. So I think when we look at the state of global network hash rate for the Bitcoin network, global network hash rate has obviously increased and difficulty has increased meaningfully since the last halving, and there's another halving coming in 28. As we think about the implications on EBITDA margin or gross margin, there's been compression over the last cycle. And when you think about the opportunity that HPC provides is to reflate that margin with a more stabilized, contracted rate of essentially renting that power and infrastructure to these neoclouds and hyperscalers. And so this is a bit of an off-ramp from that compression that has been seen in rewards output from clearing blocks for the Bitcoin miners. And so it is a way to diversify the revenue base, to accrete margin. However, it does require a substantial amount of capital. And so you need the right contract counterparty and the right partners and the right project financing to be able to deliver on that infrastructure. Those are the challenges, but the opportunity is a significant margin opportunity given what has happened to the broader Bitcoin network and the growth there and the dilution of any single miner's ability to represent a proportion of that network.
Right. Paul, thanks so much. Really interesting stuff. Appreciate it.
Thank you.
We got much more markets action coming up. You're watching Market Catalyst. Stay tuned.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you are seeing stocks mostly in the green. However, the Dow just turning slightly negative, really just hugging the flat line there. The NASDAQ is up around 0.8%, where the S&P 500 is up roughly 0.4%. And what's helping lift some of those broader indexes, the NASDAQ in particular, is shares of Tesla. We are seeing Tesla up around 7% at this point in the trading session. And this comes after CEO Elon Musk disclosed on Friday that he has purchased around $1 billion worth of Tesla stock. That's actually helping shares turn positive for the year. Year to date, we are now up nearly 5%. Now, this is giving investors confidence that Elon Musk, he's in it for the long haul. He is one CEO that is closely watched, a lot of confidence in his leadership, and that has really been directly correlated to the stock performance. When you've seen the stock oscillate, that's usually tied to Musk maybe having some more distractions out there. But this is reaffirming that he is here to stay for this company, and perhaps also reaffirms some longer term growth options for the company, like robo-taxis and autonomous driving as well. Now, what stands out here is NVIDIA is trading in the red, down around 0.5%. And this comes after it's once again caught in the crosshairs between the U.S. and China. China accusing NVIDIA of violating its antitrust agreement. You're seeing shares struggle there. However, if you look at the year-to-date performance, we are still up over 30%. And this comes as there's just more confidence in the AI story overall, along with the demand for AI and a lot of those data centers as well. Alongside some of the gains we're seeing in Tesla, you also have Alphabet shares up 3%, Apple up 1.2%, Amazon up nearly 2%. On a sector basis, no surprise that we are seeing the consumer discretionary sector leading the way higher there. Tesla is included in that sector. You also are seeing communication services, technology, utilities trading in the green. And then on the red, you have healthcare, consumer staples, materials, some of those more defensive areas of the market underperforming in today's session. But I also want to take a look at the Russell 2000, especially as the Fed readies that rate cut in just a few short days. Markets pretty much pricing in with 100% certainty that we'll be seeing that 25 basis point cut on Wednesday. You have seen those expectations reflected in the moves of those small cap companies. This is the Russell 2000. If you take a look over the past 3 months, we are up about 15%. This is outpacing the benchmark S&P 500. And related to expected cuts, we can take a look at what's going on in the bond market. And we have seen a consistent downward trend here in long-term Treasury yields. You're seeing the 10-year yield hovering just around 4%. The 30-year yield is below 4.7%. And along with the Fed's policy decision, we'll also be receiving the much anticipated dot plot, and that maps out where policymakers expect interest rates to head in the future. So we'll be watching for that. We have full coverage coming up on Wednesday, but in the meantime, keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Alphabet, Robinhood, and Broadcom. First up is Alphabet, reaching a $3 trillion valuation. Wall Street's been bullish on the stock after clearing an antitrust hurdle. Today, Citi raised its price target on the Google parent to $280 from $225. Analyst Ron Josie sees an accelerated product development cycle that's beginning to emerge with greater Gemini adoption across both its ads and cloud businesses. With the case now out of the way, investors are turning their attention back to the potential for gains in Alphabet stock, which is the cheapest on a PE basis among the Magnificent Seven, despite the recent rally. The shares at a record today. Next up is Robinhood, launching a closed-end fund to give retail investors in the U.S. exposure to private companies. The retail trading platform said it filed an initial registration statement with the SEC, beginning the process to offer public shares of the fund dubbed Robinhood Ventures Fund 1. With many companies staying private for longer and valuations skyrocketing, retail investors have largely been stuck on the sidelines with few ways to tap into that kind of growth. And finally, Broadcom, Macquarie initiating coverage of the company with an outperform rating and a $420 price target. Analysts noting that Broadcom's ASIC technology is growing faster than GPU, driven by adoption among hyperscalers and vertical AI markets. Those shares at over $360 today. And as always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the Fed expected to cut rates this week. Yahoo Finance spoke with an expert about how mortgage rates are weighing on the housing market.
Wall Street expecting the Fed to cut rates at its FOMC meeting on Tuesday. We're looking at where the best opportunities are in the housing market. Joining us now, we have Chen Zhao, head of economic research at Redfin. Chen, it's good to see you. So let's start there on that issue of affordability, Chen. Now, Mortgage News Daily, I'm looking here, Chen. They say their 30-year fix, they have it pegged at 6.29%. Is that enough, Chen, to drive meaningful activity in this sector?
Hi, thanks so much for having me on today. Yes, so mortgage rates have fallen quite a bit in the last couple of months because we've been getting weaker economic data and people are, thinking that the Fed is going to be cutting a little bit more. And so far, we haven't seen a very meaningful pickup in activity yet. But I do think that a lot of buyers are sitting on the sidelines because they're hearing that the Fed is cutting next week without realizing that mortgage rates are forward looking. So those cuts are already priced into mortgage rates. So I think when we do see that the Fed execute that cut, we will see more buyers coming into the market. It is helping with affordability. People are able to buy more house now with the lower mortgage rate. And on top of that, it's not just mortgage rates that are lower. Home price growth has also eroded quite a bit this year. So home prices are actually growing slower than inflation right now. So yes, homes are still unaffordable. Affordability is still an issue, but I think buyers are catching a bit of a break right now.
So I'm just interested, Jen, what would drive more meaningful activity then? I mean, what's the level? Is it, is it 6? Is it a 5 handle?
I mean, yes, I think if we broke into the 5s, we would see a lot more activity. But I do think that right now, the level of activity that we're seeing is not commensurate with the level of mortgage rates that we're at actually already. So I do think that once the Fed has their meeting next week, we will see more activity in the housing market, and we will see a real pickup relative to where we've been for most of this year.
It's interesting, Chen. Affordability is obviously one big issue, but I would imagine, and correct me if I'm wrong, folks think about a number of variables before they decide to pull the trigger on buying a house. Like I would imagine you think about, okay, well, how do I feel about the economy? How do I feel about the labor market? How do I feel about my job? Are those also considerations for folks?
Yes, I think you're, really hitting the nail on the head here. It's a double-edged sword, right? So right now, what is driving mortgage rates lower is the idea that the economy is actually getting a lot weaker. And if that continues and it worsens, then mortgage rates will probably get into the 5. But on the other hand, now people have to worry about whether or not they're still going to have a job next year or, in the years after that. And so that is a double-edged sword. I think the effect of a recession on the housing market is actually very difficult to forecast because historically, if you look at the data, the effect is very mixed. It really depends on the size and the shape of the recession. It depends on who is being affected, and it depends on how deep the recession is, and also depends on just simply what's been going on in the housing market before that. So I don't think anyone can really say with any certainty if we were going to a recession, does that mean home prices continue to go up, or does that mean home prices drop, or all of these things are really hard to nail down. But there is a world in which I think mortgage rates are substantially lower next year. There is a bit of a recession, but I think we will still have enough people who can afford to buy, who would buy, and who would jump in, who maybe have been waiting actually on the sidelines for the last 2 years. So we could see a pickup in activity next year.
I'll get you out of here on this, Chen. We've been talking about sort of national trends here. I am curious, though, are there important regional differences you would call out as well? For example, as you look across the country right now, Chen, would you say, hey, there are pockets of what you would consider relative opportunity?
Yes. So something that we measure at Redfin is just the number of sellers that are in the market relative to the number of buyers that we can estimate who are actively looking at homes right now. And we look at all the different markets around the country. And when you see is that in your Sun Belt cities, those are the places where there's a lot more sellers and there are buyers. And you see that reflected in home prices. So in a lot of these places, home prices are either outright falling or home price growth is very low. So these are places where if you are a buyer, there is an opportunity to negotiate concessions, to negotiate, a lower price. You probably have a lot of inventory to choose from. So these are pockets of opportunity. The real epicenter, I think, of the weakness right now is in Florida, especially along the coast, and then also in Texas.
Fed week is here, and one rate cut is a base case, maybe even two, though. But the big question is not how many, it's the story. Is the Fed taking a little insurance out, or do they need a fire extinguisher because something's burning? And that's what we're breaking down on today's Stocks in Translation. First, a quick definition. A rate cut is when the Fed lowers its short-term policy rate. A single cut is 25 basis points or a quarter of a percentage point, and a double is twice that, or 50 basis points. And note that we're talking short-term rates only, not the ones that affect your mortgage. And when it comes to rate cuts, there are two different flavors. First, there are insurance cuts. That's when the economy is okay, though it might be slowing down. Bank stocks and smaller company stocks are holding steady, and the Fed is cushioning risk early. But sometimes the Fed is making a behind-the-curve cut. Data is worsening. Credit gets nervous along with those bank stocks. In this scenario, the Fed is chasing a downturn in the making. So let's set up these possibilities in a chart. This chart comes from Brian Levitt over at Invesco, and it shows how the S&P 500 typically behaves around the start of a Fed rate cutting cycle going all the way back to 1970. Note that horizontally, the chart begins 12 months before the first rate cut and extends to 12 months after that cut. Vertically tells you how much profit or loss is. Now, the first scenario in white tracks what happens to stocks when the economy is already in recession when the cuts begin. That happened 4 times since 1970 and actually produces the best return, 28%, though it's a little bit bumpy after that first cut. Secondly, the green line shows what happens when the economy falls into recession within a year after that first cut. This is the worst case scenario for stocks, which happened 6 times and produced an average loss of 13%. Finally, in blue, we show what happened when there was no recession. This happened 6 times and boosted stocks by nearly 20%. It's also the smoothest sailing for stocks. Unfortunately, we almost never know until we're in a recession or after it's already started and ended. So all we're showing with this chart is that stocks prefer Fed insurance cuts, and they don't like to see a recession sneak up. But we can point to some markets that will give real-time indicators if the Fed is starting to lose control and becoming reactive instead of proactive. Now, right now, markets are behaving like there's an insurance setup. In this chart, we're showing 3 things that are interest sensitive: small caps, bank stocks, and home builders. Critically, all of these have been heading higher over the last 3 months. But according to Michael Hartnett's team over at B of A, there are some key levels to watch in 2 of these. For the Russell 2000, tracking small caps, watch the 2400 level. Right now, we're just barely above it. Ideally, you're going to see this market rally from here. But if it decisively breaks below 2400, that means there are some problems, says Hartnett. Then watch the KBW Bank Index. It's just over 150 now, and we don't want to see it below 140. Simple enough. You can monitor both of these on the Yahoo Finance site and mobile app. And finally, B of A says it's important to watch corporate credit, specifically something called the IGCDX index, which heads higher when companies are facing borrowing stress. If you don't have access to it, just watch out for headlines that are about corporate credit breaking down. Now here's a recap of what to watch next. 1, pay attention to those critical levels in small caps and bank stocks. Then watch the Fed decision this Wednesday. If the Fed goes double, guess what? That might mean they're a bit fearful and behind the curve. Then watch those jobs reports. Last week, the weekly unemployment insurance number, it jumped to a 4-year high. If that trend continues, watch out. And finally, pay attention to headlines about corporate credit freezing up, because right now, money is flowing like water. Bottom line is, rate cuts are not necessarily a free lunch, so context matters when it comes to what the Fed decides this Wednesday. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more Market Catalysts.
The U.S. and the United Kingdom unveiling an agreement focused on the development of nuclear power. The key focus of the so-called Atlantic Partnership for Advanced Nuclear Energy is to make it quicker for companies to build new nuclear power stations in both the UK and the U.S. This is the latest sign of momentum in the nuclear power space and amid growing energy needs. For today's Investor Playbook, we're digging into the names set to outperform in clean energy and utilities. Joining us now, Paul Zimbardo, Jefferies Managing Director for U.S. Power, Utilities, and Clean Energy Research. Thanks for being here, Paul. Appreciate it.
Thank you for having me on. Appreciate it.
You recently wrote about utilities underperformance, you and your team. And it's curious that given that utilities were sort of an AI-adjacent belle of the ball really last year, what do you think accounts for some of that more recent weakness that we have seen, even when we keep seeing headlines like this U.S.-UK agreement today?
Sure. And I think your prior segment described it well. The market is thinking that there'll be these Fed insurance cuts. So utilities are a very interest rate sensitive sector, but they typically perform better when there's real downturns, when people are fearful about the broad economy. And that's not what's driving the interest rate cuts, at least right now. So the utilities performed quite well last year, one of their best years in the past 10 years. But right now, people are looking for a little bit more of the growthy sectors like technology and others.
Now, utilities hadn't traditionally been thought of as a growthy sector in that category. But as I mentioned, they've sort of caught this AI wave to some extent because of the increased energy demands, because of the build out of AI data centers. So where are we in that cycle, if you will? And, is there still good opportunity for growth for some of these companies who are capitalizing on that?
Yes, absolutely. So it feels like we've been talking about AI for a long time, but it's really just the past year and a half, at least in our world. So we really like these mid-sized vertically integrated utilities that can see accelerating growth to support the data center. So this means the utilities that can own power plants as opposed to just the transmission distribution wires. And here the regulated utilities are the picks and shovels of that AI gold rush. They're building the new power plants for the hyperscalers like Meta, Google, and others. And they're seeing their earnings per share growth guidance really accelerate as you look into the 2030 timeframes.
So I know one of your top picks is Entergy, which we were just showing. That stock hasn't really underperformed. The stock is up about 19% this year. So it's an example, I guess, of one of these vertically integrated companies that you're talking about. I think it's mostly in the Southeast. So what is it about its profile in particular that's attractive?
Yes, no, you're exactly right. So they're the Gulf Coast, and really they have some of the strongest relationships with the hyperscalers. So they're building for Meta in Louisiana. You probably heard about that one. It's Meta's largest data center. They have Amazon in Mississippi, Google in Arkansas. So they have these deep relationships. They have sophistication with energy customers in the past, and they're working hand in hand with them, and well as the governors, the legislatures, to really move quickly to secure the power they need. So we see them as the largest builder of new natural gas power plants in the United States, and they've experienced building through the challenging times during COVID. So we hear a lot about supply chain, other constraints, but we're pretty confident that they can execute.
Do you expect to see more of those types of agreements, like the one that you mentioned between Meta and Entergy? And what is the structure of those agreements? How do you anticipate they will sort of play out?
Sure, absolutely we do. So it's a trend that has started a little bit slow in 2024, but it's really accelerating in 2025. So we anticipate a lot more relationships being struck between the regulated utilities across most of the U.S., including Entergy as an example, and that the terms are quite favorable. The data centers want to be good corporate citizens. They're willing to pay more than their fair share. So that example in Louisiana, all of that infrastructure is only going to cost about $2 a month, despite all the economic development activity that comes along with it. So we definitely think there'll be more of those popping up across the U.S.
And you talked about the interest rate sensitivity of the group. Do you think once, we know, or we think we know, that the Fed is going to start cutting interest rates this week. Do you think that could potentially unlock more value here, or is some of that already priced in?
I think a lot of it would be priced in, but there's a real fundamental benefit for the sector. They use 30-year pieces of paper, and there was a big benefit when interest rates were low. They locked in rates, not that we're going that low, but 2-3% for a period of time. So there is a nice fundamental tailwind. And all of this acceleration I was mentioning is purely from the data center side. That doesn't embed the real benefit you could see from the lower rates. But I'd say a lot is priced in from a psychology standpoint, but there's incremental upside to numbers.
And of course, speaking of numbers, we'll be watching the next time that many of these companies report earnings, which should start to happen in October. Paul, thanks a lot. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.